Hey, good morning, everyone. Um, it's good to be back in the clubhouse with hopefully more participants than last week. Sorry, I messed up the schedule and I was traveling on Friday, and it's hard to get communication out like I needed to. So we're back at it today. We got Richard back. We don't want to ever go through that again. Whoa, how scary was that, everybody? Clubhouse without Richard. Don't want to do that. So glad he's back, and sorry we missed the recording last week, and hoping we'll get that back too. But anyways, anybody have anything they want to start off with? Any questions or comments? Go ahead.
Yeah, thanks, Jerry. Hello, everybody. I think we touched upon this last time, last week, to be exact, in terms of just the topic of trailing stops and different ways to trail stops. So, I guess just to clarify, I think we can all agree in terms of setting the initial stops, which are based on the average true range, just to normalize risk. But once we're in a position and that position is profitable, we want to be able to lock in some of those profits. So, some of the ways that we lock those profits is based on volatility, I'd say. So that's your chandelier stops, which basically just trails, 3 or 4 times the ATR, the average true range of the last 20 days or 50 days or 100 days, behind the highest high or the highest close in the sense of a long. You also have the chandelier stops, the all sort of volatility stops essentially. Then you have your end day exits, which I guess would be your Donchian stops, essentially saying if the market goes, 40 days, if it hits a 40-day low, then you're exiting that position, which I guess is a stop based on price and time. And then you have your market structure stops, which is basically trailing behind the market pivots. These are a bit more discretionary in nature. So I know, Jerry, you mentioned that you prefer the Donchian stops. It gives a bit of more room. I think in my back testing, you are right. I think that the Donchian exits, the 50-day low or the 100-day low in terms of a long, does produce the best return. That comes at a cost of a steeper drawdown and less accuracy than, say, the average true range stops. But the ATR stops tend to come produce a little bit of less drawdown, better accuracy, but less overall return. I haven't been able to back test the market structure stops. I think those are quite discretionary in nature. But I just wanted to get everybody else's thoughts to see what kind of trailing stops they use, specifically why, and any back tests they've done in terms of their preference. Thanks.
Nice recap, Boris. Look, for me personally, I just keep it simple with mine with ATR-based trailing stops, but I tend to trade multiple systems for a single market, but all of them possess different ATR-based trailing stops. So I can see, there'd probably be good diversification potential by using, Donchian stops, as you're mentioning, and chandelier-based methods. But personally, I just use the ATR-based regime.
Yeah, I I used a breakout stops channel, Donchin. Bar chart calls them turtle channel. I like that name much better, of course. But I have experimented and used ATR based stops. And I talked about this with Niels, I think, last week. And I don't like using those ATR stops because, well, first of all, I would say that I'm not, I think what Boris said, just a minor comment on this idea of I'm not wanting to lock in any of my profits. No, I'm saying that tongue in cheek, but like that's not a goal. No, no, no. My goal is to make the most amount of money when I'm risking, 30 to 50 basis points. And if I ran back test and I was comparing breakouts or with ATR stops or a length of a breakout with, short term or long term, or the length of ATR stops 3 to 4 to 15 to 20, silly me, I would default to the one that made the most amount of money when I risk my 30 to 40, 30 to 50 basis points on a stop loss. So that's how I would do it. So And I like these breakouts because they do keep you in the trade longer. The computer rewards you for that. So yeah, it's a no-brainer. And also I don't use moving average crossovers. I've looked at those, and they look goofy to me sometimes. Sometimes it's the 300-day low, and I'm still long. I just can't handle that. That's just from my experience, not the computer. Saying I just can't handle that is not something I should say, of course. I can handle whatever I should do. I should strive to do that. But I've struggled with the ATR. I don't know what chandelier stops are, so you can tell me what that is. And then I don't really think I understand market structure stops, discretionary in nature. I don't think I understand that. So, but the problem I've had with the ATR stops, and I mentioned this, I think, on the podcast. Well, first of all, I would use to sort of mimic my holding period for the in comparison to a breakout, 100-day, 150-day breakout. I would have to use something much greater than 3 to 4, although maybe not, because sometimes if you're using the current ATR, that 3 to 4, it starts getting further away from the market. Like you come in today and your stop's at X, but now because of volatility and the recalculation of the ATR, the 3 to 4 ATR is even lower. That's hard for me to accept as well. That's kind of unusual for trailing stops. They tend to move up. And then, so I would had another way to concoct and calculate the ATR to where it would not be subject to massive, moving my stop away from where it was the day before. And then of course, Eric, my friend Eric, who used to work at Blackstar, then Longboard, and now Standpoint. When I met him 20 years ago, he used a 15 ATR trailing stop, but with the caveat that you couldn't move, it could never go lower, could not go further away from the market. So it kind of locked in at a level, and then if the ATR started getting larger, which would have in fact moved the stop away from the market, he would not allow that to occur. It could not get further away from the market than it was the day before, which, that seems to be less than maximum robustness to me. So anyway, sorry about the length of that comment.
Yeah, thanks, guys. Just to clarify that, Jerry, so Chandelier Stop, I think it was by Chuck LeBeau. I think he invented it or came up with it. Correct me, somebody, if I'm wrong on that. But it essentially is it's just a calculation that's based on the ATR, but it hangs from the high or the low of the current market price. I prefer to have it of the current close. So yes, in that sense, then it wouldn't be ever lower for a long than the last, I guess, price. So you wouldn't be adjusting it on a bar basis. If the market sold off, it wouldn't go below your previous day stop loss. And in terms of the market structure, I guess in terms of just overall pivots of the market or swings, to clarify, you'd be placing in an uptrend. Once again, just for simple explanation purposes, in an uptrend, you'd be placing it below the I guess last two pivots or the last two lows. Essentially saying that you're not using any indicators, you're not using any calculation other than just market structure or price in another way.
Hey guys, hi everyone, glad to be here. I had some connection problems, but I think I get the question right, Boris. From my perspective, and first of all, I'm still learning, trend following, always learning actually. I use three kinds of stops in my system. One of them is the turtle channel, as Jerry said. I like that term too. Never heard, but I'm adopting it as of now. And that moves with the market. It's a kind of a trading stop. The other one is a hard stop that's set up the moment I put the trade. And the third, I've never heard of this Chandelier Stop, but I think it's is similar of what I do. Every time the market makes a new high, I calculate distance in terms of ATR from this new high, from the ATR that was on at the moment I first opened the trade. That's important to note. And then I calculate this distance, and this is a third kind of stop. And every time the market, suppose I'm in a long position, every time the market makes a new high, I update this third stop, and then I have three numbers, three stop prices, and if the market hits any of these three, if I'm long, supposedly it's the highest, then I stop my trade. Normally, this third kind of stop, this so-called Chandelier Stop, I'm not sure if that's exactly what I'm doing, but let's say that's it. Normally, that's the stop that is more frequently hit when the trade is profitable, and when it's not, then it's the hard stop, or that turtle stop. So this is some information I gave to you, and to be honest, I would be glad if you had any opinions on that too.
Yeah, no, that's right. I think you're describing the Chandelier Stop there, Bruno. I guess exactly what it is. I guess my question then is, in terms of volatility-based stops, how you determine your multiple. So is it 2 times, 3 times, 4 times? Now, just based on some of the research I have done, I think 3 is the standard. That'll obviously, like I said, less drawdown, better accuracy, but worse return. Once you start going into the 5 or 6, and I'm talking about futures here, you start to kind of almost match the result of a Donchian, let's say 50-day low for a long. So it's kind of funny how that works out. For stocks, I think if anybody does trade stocks here, definitely the multiples of 5, 6, 7 times test out better, if not even percentage-based stops. But I think using percentage-based stops in futures is a bit crazy. So I just wanted to ask how people have set their multiples if they are using the volatility, or even how they set their Donchian levels, 50-day, 100-day. That'd be great if somebody could just kind of shed some light on that.
Yes, Boris. What I do is I use the data to tell me, where to set it. So when I'm doing my back testing, I might use a 40-year history of a particular market, and then I'll also then test it across maybe 30 or 40 other markets. The idea being in that I'm fairly sort of, I don't care which market I'm trading, it's just data to me, but by blasting it over, and because I'm using ATR-based normalization, and just to confirm, Jerry, I never go backwards in my stop, so it probably is more like a Chandelier Stop, but by testing it across this vast array of different data sets, and using this ATR-based normalization method where every data set is just a different sort of historical path, basically. What I'm doing there is just ensuring that the noise that's in the market data, I'm trying to avoid that noise to not compromise the outliers when I catch them. So my story is using the data to confirm what those levels are. So, and I do this annually. So each year there might be slight adjustments made in those parameter values, but it's continuously using more and more data to sort of get clear of any sort of historic noise.
Awesome. And sorry, just one final question on that, Richard. Now, in terms of noise, that's an interesting subject. My testing has shown, I think, after 2010, the noise factor has increased. So let's say using, you could prior to that get away with a tighter stop, a tighter trailing stop of 2 to 3 times ATR. But I'm actually seeing a wider stop since then test out. So I guess my question to you is, how often would you update that data set or that testing to see if the noise level has changed in the market? Obviously, we don't want to optimize here, but just just a basic framework. If you could kind of just explain that, that'd be great.
Yeah, so I do two components. One is this long-term data test, as I've just mentioned, over maybe 40 years and then across maybe 40 markets. But then that therefore compiles solutions that are applicable across these multi-market regimes. Then what I do is I use what's referred to as a 10-year rolling look back. So my adjustments sort of are based on 10 years of history. So, from 2010 on, my stops pretty well have adjusted based on the increased noise that I've experienced as well post 2010, but that's pretty well just started clicking in now. So it's a very slow process, but what I'm doing is just making sure that it's the data that's telling me what to change as opposed to maybe my discretionary gut instinct or judgment. So that's how I'm using it, a rolling window of 10 years. That's what I call the recency or adaptive component of my models, which just makes sure that my portfolios stay razor sharp. Well, not really razor sharp. They're always lagging by 10 years, but they do adjust.
Great, thank you.
So the Chandelier, I think I got this right. The Chandelier is just the ATR stop, and you calculate it daily, probably 15 to 20 days, and then you don't allow it to go lower, assuming a long, because it will do that. Okay, so I don't like that because that's it's a goofy calculation that, but anyways, if it's not obvious, then I definitely may have it wrong, but that just always bothered me. But I did it. And then I love what Bruno said, because I've used that as well. The stop law, the trailing stop, well, this is how I use it. A trailing stop based upon multiple ATRs, but using the ATR at entry. Yes, I used to love that. The reason I fell out of love with some of those is, well,
You're breaking
I
my
think,
heart, Jerry.
yeah, well, once again, because you make less money and the drawdowns are smaller. And since I don't pay attention too much or so much, or I philosophically don't want to pay too much attention to the drawdown in a very profitable trade, I want to make as much money on that trade. So I'll try to lock in some profit, maybe if something extreme is happening. But if I have a 1,000 ATR profit and I end up making 500 ATR profit, probably more than anyone else made on that trade, let's say, I'm very happy that I made 500 ATR. I could care less about the 500 ATR drawdown, but I wish I would have made more than 500 ATR in profit. So that sounds like the same thing, but I don't think it is. And so, yeah, because this year, if you would have used some of those ATR stops the way that, based upon the entry ATR, you would have made a lot less money in Tesla, Moderna, lumber, et cetera, et cetera. So, that's the key. Keep your eye on hunting those outliers. And the problem is not really the hunting. Oh, they're easy to find. Oh, they're out. I mean, every one of us is going to find them unless you just sort of make the ultimate type 2 error, which is not to do the trade. So it's not a question of hunting and finding. We got that part down. Everyone has that down. But how are you going to kill it? And the problem is you could kill it too soon. And if you focus too much on that char, mar, or all of those things, versus just how do I make the most amount of money given the risk, the average loss. And that's, it's very difficult to do, but that's how you maximize your profit. I wanted to mention one more thing. Oh yeah, I don't like the idea Boris had about slicing up the data. Quote, since 2010, no, I would never do that. I'm going to look at all the data. We've talked about this. If I sliced the data and looked at soybeans and corn and the wheat since 2010, I might not have taking those trades, or I don't know, what am I going to do with less data? It's not going to be anything good. Oh, and I don't like the idea that I think Boris mentioned, he insinuated that separating the futures markets from the stocks. Now, once again, I'm going to treat those the same. They are the same. I'm going to pretend they're the same. The longs look a lot different than the shorts. Stocks, I guess, can look a lot different from currencies, but in order to get my sample size up there, I'm not going to treat them different. And so I'm going to force myself not to look at the different anything since 2010 or any results, stock only or futures only. And then I wanted to ask Bruno, I like the ideas, of course, multiple trailing stops and multiple entries and adding to your profits kind of in a robust rules-based way. And that was talked about a few weeks ago with Derek and Richard. But I don't like the idea of one system having multiple exits. I think you can have, I think Niels and I talked about this, where multiple systems with one exit. So I have a system that with the Chandelier, I have a system with the moving average, I have the system that exits using the entry ATR, I have a system that uses breakouts. But combining those into one system or more than one trailing stop, in order to, that is devastating to the sample size.
Yeah, those are great comments, Jerry. Just to clarify a few points in terms of the volatility or the chandelier or whatever, Keltner channel, whatever kind of volatility stop you want to use, that hangs from the highest high that the market has closed. I guess the philosophy or the logic behind that is that once you're in a trend, you want to capture as much of that trend as possible, and you want to exit when the trend is done. I guess that's some sort of a philosophical aim that this hopes to accomplish. Now, what the Chandelier Stop is saying, or volatility-based stops are saying, is that the market should not make 5 times average true range drop from the highest high, because if it has, then something has fundamentally changed in this move, and it's time to get out. Not necessarily saying I agree with this philosophy, but that's what it kind of is, and it's saying that if it's made a 5 times average true range move from the highest high, something has fundamentally changed, and there's no reason for you to wait for the 100-day low. What I get from you, of course, is that you're saying, which does backtest well, is to say, no, if you wait for the 100 days, then that 5 times average true range move against you could obviously correct itself and the market could scream higher. I guess that's the different kind of camps that we see, or that I'm finding. Now, to your comment about slicing the data, I absolutely agree. I think what I just found is that philosophy of saying, 3 times from an average true range against you from the peak, that has slowly started to widen, indicating, this is an assumption on my part, that there's a little bit more market noise. So what worked before in terms of the 3 ATR average true range stop is no longer working as effectively. Now, obviously, you can run away with this and go crazy and over optimize, but that's just what the research has shown on my end. Now, it's a strong possibility that I messed something up in terms of how I backtest these things, but that's just what I saw. So I'd welcome any other comments of maybe Richard. I see that you use the volatility-based stops of what your testing has shown, and if you kind of agree with that philosophy or not.
Well, I certainly do agree with that, Boris. Look, the way I probably might look at things a bit differently to what some would look at it. Because these outliers that I'm catching, they're of lots of different forms. Some of them are linear extensions of data that, the equities, the indices typically have these massive, linear extensions lasting for 10, 15 years. That's an outlier in my vocabulary. An exponential trend is an outlier in my vocabulary, something like Moderna, something like Tesla, something like Bitcoin. These anomalies take a variety of different forms. So what I'm particularly interested in is different trend following systems that all obey these golden rules of trend following, but there's a variety of different systems I deploy to target those outliers. So the outliers exist in the market data. Our systems themselves, basically they're not the trend. They basically apply constraints for our entries, our initial stop and our trailing stop, to capture aspects of that trend in the market data or the outlier in that market data. So you need lots of different methods to extract what I call is squeezing the juice out of outliers, because you want to get as much of that outlier as you can, but you need different systems to target different aspects of it, because no single system captures an entire outlier, and there's a lot of noise that exists at the early stages of the outlier. But when the volatility expansion occurs and we get these massive nonlinear extensions, the noise tends to peter out. But it's important for some of my models, which are probably, some of them are a bit more shorter term than maybe some of the longer term models that people deploy, but I sort of deploy short term, medium term and long term models. They're all targeting different aspects of that outlier, and they're all very concerned with avoiding noise. So when I say avoiding noise, the only way I can do that is by using the data history itself to say, well, what is that level of noise and has it changed over the course of time? And I certainly do find that the noise has changed, and we might be able to put that down to different levels of participation, all of these different behaviours in the market that exist today. So the noise is influencing my ability to capture those outliers, and the outliers of the 2000s are different to the outliers of today, because there's this impact of noise and mean reversion at the early stages of those outliers that make it very difficult to catch them. You often get these fake breakouts, a lot of whipsaws. You want to avoid all of that stuff, so you get your multiple systems are targeting different aspects of that outlier. So that's sort of the philosophy I adopt, which might be different to others, but that's how I do it.
Hey, I'd like to address Jerry's questions. And first, I've taken notes of two that were directed to me. First of them, multiple stops within the same system. It's basically from the original turtle rule, as I read them. One of the trailing stop is based on the turtle channel, and that's updated every time you get a new data point for the trade you're on. The other one is a hard stop that is basically or essentially a risk management tool. Is that you refuse to lose more than 30 basis points, 50 basis points, whatever the number you choose. And it's calculated based on the ATR, and okay, it's fine. Okay, the reason I have adopted that third so-called Chandelier Stop, so-called because I learned it today. glad to know that it's a thing. It's not only in my head. And the reason I have adopted it is the same for the hard stop. It's a risk management tool, and then comes trend following sin, because yeah, it's a way to lock in profits. It's a way to cut a trade when it's positive P&L. But from
Jerry,
the,
do we have
from
a
the
sin
test,
bin in Clubhouse where we can send Bruno to immediately?
Well, I would be very hesitant to nominate myself as the one who determines the sins, but I think it's good to, I try to admit to mine, and I philosophically, I am incredibly strong, but in practice, not so much.
yeah, and no, I agree that that's not perfect, but from the tests I've run, and I must admit that I'm not a long time trend follower. I've been doing this for 1 year or two. From the tests I have run, I couldn't find a way to make more money without this Chandelier Stop. I assure you that I'm trying really hard, but I didn't find a way to do it. Okay, and the other question was, well, wouldn't it be better to have only one stop for each system? Why do you have multiple stops within the same system? Yes, perhaps it would be better to have only one stop, but at the moment I don't have capital enough to deploy multiple systems. I can deploy two. So when I have more capital when that's not a restriction, I intend to simplify more my systems. But that's a question for the future, Bruno.
Thank you very much. Hi to everyone. I did not speak today. Very happy as always to be here. And I want to say that I don't know the right answer, of course, for this topic. And this topic is extremely important, and it's for all of us, of course. But I have the same situation, maybe the similar situation to the Bruno situation, that I don't have much capital, and I think that diversification will give anyway a benefit for us. And I don't know the right answer here, what is better, but I did not make a very big backtest. I had not enough data for this. It's a very serious question, but for me personally, I like the position of Bruno, and I understand, I accept that maybe we are wrong, but I'm sure that if we do so, and it will be, at least it will not be the big difference. And I think if it's not enough capital, that it's not very big a problem to do. First of all, we must be uh, consistent in our strategy, and of course risk management consistency, and we must choose the one way and follow it. And as for me, I do similar as Bruno do, because I like to think in a direction of a diversification, because of this maybe. And if I will have more capital, of course I will do the same. In fact, not change my mindset. It's my opinion.
Yeah, I guess the question here is, does a 4, 5, 6, whatever, 3 ATR move from the highest high in the sense of a long against you, does that warrant a stop? Meaning, does that mean that something has fundamentally changed in the market and it's time to exit? I think I can hear Jerry saying no. Some people might say yes, because the market should not move that far away from the high if it is still in an uptrend. That's just kind of the philosophy. I guess, Bruno, I had a question for you. I guess you apply the two stops, meaning that, whatever is closest to the market is the one that you're going to execute. Now, I guess if you're using a 100-day Donchian low for a trailing stop and a 3 times average true range stop or Chandelier stop, chances are very high that that 3 times ATR stop is always going to get hit first. So I guess my question to you is then, and to Jerry's point, is what would be the point of having 2 trailing stops? Unless I'm missing something of how you execute that, then obviously please correct me.
No, you're correct. The reason I have this Chandelier Stop is basically for a risk management purpose. I think it makes more sense for shorter term trend following systems. The longer term are definitely more profitable on a trade basis. The problem is that I execute less trades, so I couldn't find a way to make a system that the whole system is more profitable. So I go for medium term, not too short term, not too long term. I go with the middle. and when I deploy this Chandelier Stop, sometimes they are hit, and some other times the Turtle Stop is hit. When the trade is profitable, of course. When it's not, it's mostly the hard stop that's hit.
So sort of what's the multiple of the Chandelier Stop that you use? I guess what I'm trying to understand is if you have an initial hard stop in the market that doesn't change, it's basically saying I'm going to risk, 1% of my account equity, whatever the case may be, and that doesn't move unless, of course, it's overtaken by your trailing stop, right? In this case, right, I would find that the trailing stop, which is tighter and more responsive to market noise, would always be trailing higher than the Donchian low. So, like, what's the multiple that you use, and when would you exit using the Donchian low if the Donchian's always lagging behind the more sensitive volatility-based stop?
No, it's not. It's not always lagging behind. Sometimes it is. Sometimes it's not. The thing is, the trading stop that I'm actually looking at, that's a combination of the turtle stop, of the Chandelier Stop. It's kind of smoother, but that's just a consequence. It's not a premise. It's not the reason why I use this. But sometimes it's one is hit, the other times it's the other.
One of the things, Bruno, just one of the things just that I am tiny bit concerned about is when you're using multiple different forms of exit, you're basically compromising the ability to let those profits run. You're taking on sort of a position of, well, I'd like to take some of that profit off the table. But you can compromise these outliers by having these multiple different exit mechanisms on your trade. So I'd tend to, just personally for me, is I would never try and compromise that outlier because they're always far bigger than we ever anticipate, and we don't want a minor fluctuation of that trend to send us out of that position, and then find that we've got to play catch up to try and get back on board again and lose a lot of the proceeds in the process to do that. So I tend to view a trailing stop as simply a mechanism to allow your profits to run. So the reason I use this sort of, I suppose it is a chandelier-based method which never sort of goes backwards, but if I suddenly get a large ATR-based expansion during an outlier, I breathe more. My trends breathe more. That allows me the ability to stay in much longer. So I can be holding for 2 to 3 years on many of my trades, simply because I'm using multiple systems. The stops are wide. They're getting away from the noise. There's a single trailing stop for every single system. So it's a one-to-one relationship, and I'm not compromising that outlier in doing so.
Hey, Seth, you have a bad connection. So I'm really enjoying Boris's comments. These are really good, and they're different, and that's really good. And people should choose what makes more sense to them. But so here I'm going to go trash Boris's comment, some of his comments. But I definitely don't agree with the idea that for instance, this may not be an exact quote, but if something like a 5 ATR retracement, we kind of know, or we kind of feel that something has fundamentally changed. The trend is over. So I definitely do not agree with that whole way of looking at the markets. No, that is, I could care less. When I look at these charts, I'm still in a trend, and maybe depending upon what the chart looks like, I'm saying, why am I still in this trend? It is definitely, the trend is over. However, when I look at the back test, this is my best performing system. So I don't care. I'm not getting out when you think the trend has ended. And I'm not, I think Seth said, like designing the exit. Design your exit based upon, no, stop. I'm not designing anything based upon anything other than the computer continuing to say to me, the 100-day exit, breakout exit is better than this 50-day, and the 125 is better than the 100. I'm going to make more money given the same amount of my same average loss that I'm willing to take on the trades. So there seems to be too much heavy-handed design mentality going into, it's not like, hey, I'm just sitting back waiting to see what I'm going to find. No, that's the way it should be. Not so much of here's my preconceived ideas about how the market should work, what the trend looks like from my eyeballs. No, you're going to make less money. Yeah. So I don't like those ideas so much. I was going to say with Bruno, I think that I was going to ask you earlier if the chandelier, I think you said, I wanted you to confirm this one more time, because I really like this idea and I've used it and I probably still use it. That is this risk control part, risk management part of your chandelier. I like that idea because the problem with long-term trend following is, number one, everyone can see that it makes a lot of money. And given today's choppiness and noise, I think the noise means we should be longer term. I'm not sure if Boris agrees with that, but I think we should be longer term and hang into the trends longer. But the problem with hanging into them longer is you could have a very large trade. The computer will say, if you trade this this breakout exit, long term, you're going to make more money. However, some of these trades, you're going to give back a lot. You're going to be very unhappy. With Moderna, you may give back almost all the profit, or Tesla, or Bitcoin. And so I like the idea that the chandelier or something like that, maybe is an alternative. That, look, I've made all of this money. Why do I want to use another exit? Because I want that money. It's all about making the money. Philosophically, yes, I'm on board. But if we've made 1,000 ATR or 500 ATR, and our trailing stop is 200 ATRs away, yes, I like this idea that on some of the position, I'm going to say, if I have a 100 ATR trailing stop based upon the entry ATR, then I'm going to kind of preserve some of those profits. The utility of that money is high, and this is not a religious experience to see if I can follow my system as if it's some sort of all-seeing, all-knowing idea. Then I'm going to want to maybe book some of that profit. And this is why the larger CTAs many years ago came up with this idea of vol targeting. I mean, that's my guess, is they said, wait a second, we make a lot of money with the long-term systems, but we'll give back too much of the profit. Let's throw in this idea of managing the current risk, pay attention to Sharpe, pay attention to monthly returns, but as a benefit of that, all of our big investors will love that idea. And they could give a flip about screwing up the trend following and screwing up the outliers, but we'll sell them on this vol targeting, and we'll have a way to get out of some trades on the way up and not have to have our entire position, like Jerry has his entire position usually sitting there, at the 100, waiting for this huge, massive drawdown that may or may not come because he's only looking at the long-term breakout exit.
Yeah, you're exactly right, Jerry. It's that chandelier stop is there with a sole purpose of locking in profits, and that's basically it. It's just to, well, I don't want to give back all the money that I had with one single trade. Now you've got me thinking, when I put them way below the initial hard stop when the trade is put on for the first time. So suppose a combination of parameters could be, I don't know, 5 ATR down for the hard stop and 15 ATR down for the chandelier stop. And every time the market makes a new high, I update the chandelier stop and calculate 15 ATR below the new high, and the hard stop is, well, it's there, it's hard, it doesn't move. So when the market moves, when the trade moves 50 ATR up, and then it gets, then I get a give back of 15 ATR, then the Chandelier Stop is hit and I exit.
And you're going to make 35 ATR on that trade.
Yeah, exactly.
Yeah, so I
But
think that's
well,
a very good idea, and I have used that before. I think that there are slightly better ways to handle this phenomenon of giving back too much profit when you're optimizing your trailing stop breakout exit. And so I think the 15 original entry ATRs sometimes gives you a bad outcome. So I like the philosophy. The philosophy is good. I use it. Now, one of the things I forgot to say was I want this chandelier based upon entry ATR, I want it to be rare. It has to be rare. I mean, in my opinion. So I'm actually hoping for a small sample size. I'm sort of saying to myself, my breakout exit strategy is wonderful. It makes lots of money. It's going to have these bad, possibly worse in the future trade results. But I don't really feel like I desperately need this chandelier, but I'm going to put it in there just in case. And I hope I never use it. It's not a material part of my trading. It's sort of not a stop loss, but a profit loss. But I'm not going to give back 1,000 ATRs in Bitcoin. I'm going to make 500 or 600 or 700, whatever. Still a painful drawdown, but I don't want to have to use this too often. And number two is, I think since I trade the long-term stuff, I don't think, maybe the medium term, it does improve the performance, but with the long term, it doesn't really improve the overall performance of of the of the of the trading. Now, but another thing to keep in mind, is that if you run the back test and you say, I think we've run it and we said, okay, it does. Since 2010, honestly, I think this is what we came up with. It does kind of improve performance. Now, the problem with that is, does it improve performance this year with Moderna, Tesla, Bitcoin, lumber, and all these mega moves? Oh, oops, now it no longer does improve performance. So we're subject to these rules that if they're kind of can be influenced by the outliers, then we may say, oh, now I think I maybe have to change my rules. And so I think this is a major problem in looking at short-term performance, because prior to 2020, we had one idea. Now after 2020, oh, now we have another idea because we've had a lot more outliers. And so that's why I'm hesitant to slice up the data too much, because we're on the precipice all the time of crazy moves that are going to move the backtest around.
By the way, I had remembered now, get remembered only a few minutes ago that I had a big backtest, a big research on a similar topic when maybe 5 or 6 years ago, when I was a short-term trader. I used multiple strategies in short-term space, and on one strategy it was trend following strategy, if we can call so, of course, by trend following principles, catching the outliers, but in short-term space, even in day trading. And so one of this was a breakout.
Oleg, you had a bad connection. I had to move you off.
yeah, just a quick point here. Yes, Jerry, you got me thinking that a couple of weeks ago you were talking about the give back on the Moderna trade, and at that time the Chandelier Stop made a lot of sense. But when you're looking for trades that give you 50 ATR tops, say, then a 15 ATR Chandelier Stop makes sense. When you're talking about a trade that's moving 1,000 ATR, 15 is nothing. So perhaps a way to do this in a robust sense could be a multiple ATR that's also updated as the time goes. So when it's, I don't know, it's if you parameterize it to half the maximum ATR you've made, that Chandelier Stop. So if a give back is too quick that would give back all the money when it hit your turtle stop, it hits your Chandelier Stop before. So I don't know if it makes 50 ATR max, the maximum give back you're tolerating is 25. If it makes 1,000, then the maximum drawback would be 500. I don't know. Does that make sense?
Yeah, I mean, and that's what we sort of settled on, that it needs to sort of be in context of what is a typical trade, average trade, or typical outlier. How does the system, what do the outliers look like based upon your system? You know, your system is driving these numbers. And back in the turtle days, a big trade was, an outlier was 20 ATRs, 20. Now, I would say for me, because I've had to extend my parameters to much larger lookbacks, 75, 100, 150. And so within that context of how those trades are popping out, given my parameters, that's the problem. You start seeing a problem using entry ATR. You know, one thing, like Moderna is a good example. I think we talked about Moderna a few weeks ago, and then I ended up being very happy. Then I ended up losing a ton of money. But one of my systems got in, you know, at the quicker than the other ones, and the ATR was 80 cents and or 90 cents, and it had an 80 ATR move in one day. 80 in one day. Now, I had never really seen anything like that before. But so that, a lot of that outlier-ishness is based upon that small ATR. Now, maybe though, after 2 or 3 weeks in that trade, you know, what are the chances, or not even that, just at any point in time in that trade, what are the chances of that trade now that the real ATR, the current ATR is so large that my ATR trailing stop Chandelier, based upon the entry ATR of 90 cents, is going to get hit? It's almost 100%. You're going to get, and then you look at the chart and you can barely see, why did I get out there? We're so close to the highs. And you're like, yeah, so I think that's the problem. You want to protect capital and have sort of a stop profit so you don't give it all back. These long-term systems are necessary, but that's what they'll do. And at least for part of your trade, you want to have a system that maybe it has this feature, but it has to be in the context of the market and what's going on and what's the ATR now and that sort of stuff. So I'm not against that, but I will say that in our back testing, and we've done some back testing recently just to confirm our parameters and see if we, you know, how our parameters were working. We did not find an increase in profits based using any kind of Chandelier retracement exit is what we call it, and we could not improve our performance. But and like I said before, I think performance is a tad better if you don't use a trailing stop. I mean a stop loss, a hard stop. But I think you want to use things even though they're not the best parameters or the best ideas in the back test, you know, for safety reasons.
Hey guys, Avi here. Great to hear everyone. I guess I'm coming at this maybe a little bit differently, given that I trade equities and specifically TMT equities. So what I've been playing with is so like if I'm long a position and you know it's run up for a while. So I have a pyramiding based strategy. So I'll add to the position as it increases, as it moves in my favor by a number of ATRs. So I'll just continue to add until it gets to my concentration threshold. But what I've been playing with is selling deep out of the money calls, long dated, to somewhat de-risk a drawdown in that particular name. And just would love to hear anybody who has thoughts about this. I guess this is somewhat along the lines of vol targeting, but yeah, it's just something that I've been playing with to reduce the volatility basically, and then not lose profits when I've had a name run up multiple ATRs. So I'd love to hear anyone's thoughts on that.
I wanted to say that, and there was a problem with my connection. I hope it's okay now. And I want to say that I get remembered that 5 or 6 years later, 5 or 6 years ago, I had research on this. I had a big back test, but I was trading in a short-term space, and so I did the following. I had a short-term breakout with hard stops, and all systems have had hard stops, but in one of them it was a trailing stop, and in another it wasn't, and in the third it was a breakout trailing stop, and I get to a conclusion that it's really better to trade in a like Jerry said, one stop, one exit for each strategy. Yes, I have found this, and I get remember this, but for me personally, it's now I trade in a long-term space, and for me personally, I don't have enough money, even in hypothetical account on collective, and don't have enough money for because of risk management rules. I think it's okay in this situation to maybe both decisions, to trade with multiply stops and not too much, of course, I think, and to trade with, if I have only one strategy, I have because of, first of all I must diversify because the markets. I have only one strategy, and I think it's okay to have maybe 2 stops. Maybe it's not the best decision, but maybe the performance will not be so good. Maybe I don't know this. I don't know this exactly. I have only my thoughts. Maybe so, but I want to say that in this situation, I think into, like I said before, into the direction of diversification. So I do diversification. It's like maybe diversification training, diversification mindset, maybe so. And for me, I like, because of that, I like the position of Bruno because of that. But of course, maybe, and according to my backtest, it also can be so that if we use one stop for each strategy, the performance will be better. But if we will have only one strategy and we have nothing to do with this, it's okay maybe to have multiple stops. It will not worsen the performance much, I think so, at least.
Javi, to expand a bit more on your point, which I find very interesting. It goes back to what I've been saying for a few weeks now, that I do believe that actually signals themselves have signaling power. So you should move more from a binary or ternary position where you're long, short, or flat into a bit more of a continuous spectrum where you have positions that carry on swinging from long to short according to some sort of scale that you can develop based on what your parameters are and things like that. So that obviously integrates nicely with vol targeting, and I know that Jerry's and Richard's seeing the bells are now on high alert. They're really bringing and swinging a lot. But I do think actually that having a more of a continuous approach to trading works, at least works for me. And also, more to your point on volatility, I think a couple of weeks ago we spoke about how good it would be. Obviously Derek is the master. How good it would be to sort of integrate options with trend following, because there are clear areas where they overlap. Obviously, the problem with options is the cost of the theta burn versus gamma capture. But yes, I mean, your ideas make a lot of sense, at least.
Yeah, I mean that's exactly what I'm thinking about. Is like after I've had a big multi ATR run in a position. So just talking about on the long side, just for simplicity, if I have multiple ATR run in a position, the stock tends to like peter out. Like it may not go down, but it just spends a lot of time at a flat level and doesn't move. And so by selling calls, I get the theta pickup where I get the theta. I get the theta decay, and but then should the stock gap down, I can pick up the profit from that call. And if I close, and then if the stock hits my exit, that would mean that the volatility would have picked up, so that call would become even less expensive to buy because the implied volatility would increase. So, I mean, that's how I'm thinking about it. And yeah, so it seems, it's early days for me in chasing after this, but it seems that with the implied volatility pickup, should the stock hit the stop, which means it would have traded down multi-days, and then the call become cheaper. So it seems like that it makes sense to me. But yeah, so yeah, any other thoughts?
Is it fair to assume then that there are two different camps here? So there's one camp that says with the Donchian channel, and unfortunately I can't comment on the option piece just because I'm not overly familiar with them, but is it fair to assume then that one camp says that the volatility itself of a move, it doesn't matter. It doesn't matter if the price retraces 4 times the average true range, 6, 7, it doesn't really matter. What does matter is that you're going to exit after a specific period of time, which the Donchian, I guess the Donchian does use the price and time feature, but it says, price should not be, I guess, correcting against you for 40 days or 50 days and making a 100-day low, whatever the case may be, whatever your parameters are. And there's another camp that says, no, it is based on volatility because volatility is important. It can indicate or signal that something has changed and that it's time to exit that trend. Is that a fair assumption? Now, to Jerry's point, I don't, to be honest with you, I don't know. I've back tested some of these things. I do agree that the Donchian style trailing stops do back test slightly bit better at a cost of a drawdown, which I don't think you're overly concerned with. So it does back test a bit better. I guess it's just in terms of the volatility, the philosophy there is that you will be able to catch some of these moves a bit quicker. Now, what I don't like about the Chandelier stops, and I think it's worth exploring something like a Keltner channel, which is essentially the Chandelier Stop says that if a bar makes, a 5-6 times ATR move, that's going to tighten that stop. That's very dependent on one market move or one bar or one, a day's worth of action. What you can technically apply is you can say, well, what is the average move over the last 20 days? And then take an average true range of that, a multiple of that, which is essentially what a Keltner channel is. Ironically, that doesn't actually backtest as well, but it is another option because it will allow you to stay in some of these moves a bit longer. But just wanted to kind of get everybody's thoughts on that specifically, if I'm understanding that there's kind of two different ways of approaching this.
I couldn't figure out which camp I'm in, but sorry, I lost you, I think, on that. But what I was going to say was, to Avi, yeah, you see, we understand what you're saying 100%. I understand everything you're saying, but what we're advocating, what the classic trend following approach says, yes, you'll handle most of your trades better than I will. 100%. No, there's no doubt. Um, but I'll make more money than you over all of the trades because I'm waiting and hunting for that outlier. And so I'm going to sacrifice the trades that I'm doing now. You see, like for instance, with lumber, I gave back way too much profit in lumber. I used the same system for Lunda, Moderna, Bitcoin, and Tesla, but lumber sucked. And I knew it was going to suck. Iron ore, I gave back too much profit in iron ore. I knew that. But overall, because I still have those big outliers that are still going, I'm going to make much more money. So we know that per trade, there's so many common sense things we can do. I didn't make very much in the currencies either because I started just letting them, those moderate style profits turn into really small profits. But if I'm going to compel myself to use the same systems, the same entry and exit, stop loss, then some of the trades are not going to look very good because I'm totally obsessed with 500, 1,000 ATR trades that historically the computer says, yes, you suck almost all the time, except at the end where you make more than others. And then, of course, good idea, not paying too much attention. I'm choosing my words carefully here because I want to give myself an out later in another conversation where I can say, I never said, you can't cheat a little bit. But good idea, not paying too much attention to the drawdown and volatility in very large profits. Drawdown and volatility in the portfolio, I may have to rarely make some adjustments there. Rare. This is a rare thing. My desire and hope is that these one entry breakout, one exit breakout, and a stop loss, ATR based stop loss, this is all I need for the rest of my life. But sometimes in rare situations, yes, I'm going to have to maybe do something outside of that to stay in the game and not, uh, not give back a fatal or lose a fatal amount of money.
One of the reasons why I get laughed in classical trend following was that I had a lot of, I have told very often that I had a lot of research in different directions. I have even anti-trend following research, that for example, I had a breakout signal and in short term, and my stop was maybe with a stop loss, but without trend stop or something like this. But my stop was in maybe in today's in 10 days. I different researches, and I understood especially when I listened to Niels, Maurice, and Jerry, I understood this wisdom and understood that classical transformation is the best way of doing things. Is the best that I have heard, that I have seen in trading space, and I get laughed in it, and I'm ready to fight for it.
Yeah, no, Jerry, I definitely get what you're saying, and appreciate the experience of you and everyone else in the room that classic trend following, entry, exit, and stop, and that's it, yields the best results. The caveat being is that you have to have the mental fortitude and the wherewithal to deal with the volatility, and all of that volatility opens the door for mistakes. And so maybe that's what makes a better trader than others, is being able to deal with that volatility and not make mistakes. But so I think that's kind of why I'm thinking about this. And but yeah, no, I mean, I appreciate what you're saying and your experience and having moved with this strategy. It's just my fear is that having so much volatility will lead me to make mistakes.
Definitely. And it definitely leads you to not being able to stick with your rules. And that's where I've gotten in trouble over the years, is I traded too large. And I was having bad losing periods, and it's just difficult not to override, and it's hard to stay with your system. I think one of the things that Rich has talked about is trading a lot of markets, so your bet size per market can be very small, and that sort of helps out a whole lot. Yes, we had a bad day in iron ore or lumber, but it's 1 out of 120 markets. And I know a lot of people can't trade 120 markets, but that's sort of one of the secrets is in order to trade small and trade each individual market small, and that is I've had many years of experience of forgetting that rule.
And I think we must understand that we are not on a building works on a construction or something like that when we pay it every day. And so the non-linearity, it's very important to understand. Like Rich said, Jerry, Niels, Maritz, we don't take profit every day, but it's the things. For me, it will be very wonderful for me to know how to make profit every day, how to predict the markets, how to trade without a diversification and have consistent profit. But things are not organized in such way. They don't work in such way, and we must do the thing something like to be in sync with the things. I think with the laws of nature.
Can I ask Avi, just based on what I've learned about trend following, it does seem like what Jerry's saying. There are a certain number of, Bitcoin and Tesla that go up so much more, and those are the ones you're trying to stay in. As I do deal with a little bit of options, I'm curious why, if you've considered buying out of money puts, which I know will have, some people up in a huff. But if you get your system really humming and get very accurate and only do it, under specific circumstances, if you buy an out of the money put, if you're long, at the level which you would want to get out if the movement starts to go down, as a little bit of insurance, have you looked into that?
I haven't looked into buying puts or calls. I've been selling puts and calls to pick up the theta decay. So um, that's how I've been thinking about it.
And that makes sense. And I know it. I want to emphasize it really has to be a very well tested exit point, but it's a little bit of insurance. But at least you're not limiting your upside. Anyway. Something to think about
Yeah,
that
but
I use on my particular.
basically to reiterate the point that Avi made before, and I sort of hinted to as well, buying very out of the money optionality gives you, a lot of convexity when you need it. The problem is it's very expensive relative to the the sort of returns profiles that your trend following system makes. True, you have outliers, but in the trend following, you have a lot of missed trades. Your hit ratio is not fantastic. So if you burden, if you wish, your system with buying deep out of the money optionality just in case for when things start moving against you, I think it's at least in my experience has been a non-starter. The game isn't worth the candle at that point. So you have to resort to certain things. And to the point of two camps, Boris, I think there's a little bit of two camps, but there's the classic trend following. Jerry and Richard are the prime exponents and practitioners of it, and the heterodoxy or the sort of the sinful people like me that just do things slightly differently. So yes, I think there's a deviation from Richard Dennis's and Jerry's discipline here. I don't practice. I mean, though I'm really fascinated by the way those guys trade, I find it, and Jerry said, it requires a certain type of personality which I don't have, and so I have to resort to all sorts of things and design the system slightly differently. So I do feel like in this room, and that's the beauty of it. That's where the information happens, because it's very valuable hearing from the masters in a certain discipline to sort of question your approach. But I do feel that there's philosophically some difference between the different people in the room.
I agree with Bruno on all of that. We don't want everyone agreeing, and I don't want everyone or anyone necessarily agreeing with me just because it's me saying it. But I would say that my obsession with all things trading and research and back testing is sample size. And the multi-binary systems, I think, versus the continuous approach, does allow us to have an entry, exit, stop loss, count those trades, and that is above everything else. And it's not massaging the back test in order to have a good equity curve and a good sharp or better sharp is not the same thing as counting those trades and attempting to have a systematic approach where you can actually count the trades, the entries, and the exits. And we do attempt to trade multiple of those binary systems to try to get close to what the back test would look like on a continuous approach, which is, I think, is going to test out better. But I just don't understand. I think that the cliche of cut your losses short, let your profits run. You don't have to agree with that, of course. You don't need to agree with that. And just because it's been around for hundreds of years or 100 years, that doesn't mean much either to me. But it definitely does insinuate that you treat the losses different from the open trade profits.
And I think that truth has such a quality that it's easy to check in all aspects of our life. I think almost all aspects. It's easy to check and it's checkable. And here I see that it's checkable, that it's truth. I understand the logic that lies behind trend following. And here is my point.
I'm going to have to go to church on Sunday to go to confessional to repent for some of the sins I've been hearing.
That's me laughing. I'm going to just hit my microphone like 10 times in a row whenever I'm laughing, because a big part of my enjoyment is being funny. But in this, when we are always muting these mics, I'm not getting the positive feedback from all the people who I know are laughing at how funny I am. I did want to ask Richard one question. Oh yeah, I was trying to take notes when you were speaking earlier, and I wanted you to, if you could just give us your opinion on this idea of noise. I think what you mean by noise, I think I wrote down there's some noise. We need to be careful about the noise at the breakout, at the entry, and the early stages of a trend, and try to not get shaken out, I think is what you mean. And then I wanted just to see if it was a fair representation to say, but once we get going in these trends and it's early days, it's not, it hasn't been our year or two holding period, because my average holding period is over a year, then maybe noise is not less of a concern. And then when the trend ends after a year or two, it's not necessarily due to noise.
Yeah, so Jerry, the way I see it is that I always tend to look at my trade distribution of returns, so my trade history, and I plot that out on a histogram, and then what I'll do is I'll overlay over that trade distribution a normal distribution. And what I'm saying is that within that normal distribution, that's where the bulk of participants play. That's where mean reversion plays. That's where so many different types of trading behaviour play in the market. And then there's these tail regions that lie outside that region, which is what I'm saying that the classic trend follower, that's what they're targeting, those tail regions outside of that normal distribution. So within that normal distribution, a bulk of that activity is random. And I see that in my equity curves every day on my backtest. What I'm doing is when I'm looking at my backtest results, I'm mapping that. I'm mapping those equity curves to identify what are the actual outliers in that equity curve and what is randomness. Because what you find in your backtest is that there's a large percentage of noise in your equity curve. You can't help it because that's just the way it is. There's noise in the market, and you will catch a lot of that noise, and that's what these whipsaws are. That might be noise, or it might be mean reversion, which is the opposite of what we want to attract. We want to attract these trends in these tail regions. So that noise or that randomness in the equity curve is really quite prevalent. So if you're choosing the best performance based on a backtest, that could largely be simply due to random noise effects that are giving you a beneficial outcome. And when I put that Twitter tweet up last week about comparing Brent and crude together, when you map them together, you can see that there are times when you're trading either Brent or crude that your equity curve departs from each other. The equity curve of Brent might be rising, the equity curve of crude might be falling. But when you look at the market data itself, it's highly positively correlated to market data. So that tells me that splaying or the divergence in that equity curve is just randomness. And that's just, the flip of a coin. So when I'm looking at my equity curve, I'm extracting out all of those things I regard as randomness, but I certainly can identify where the outliers are because I map that against the market data itself, and I can see where those outliers are. And if my models aren't catching those outliers, that's a sin to me. But the rest of the equity curve I can basically just discard because it's just random. So that therefore means that I'm very pedantic about not taking too much attention to backtests or the equity curves of backtests until I do this mapping exercise, because what I'm wanting to do is just target the outliers. So ideally in my world, with crude or Brent, over a 40-year period, I might only want to be participating in those markets 6 times when there were 6 clear outliers during that 40-year period. The rest of the time, I actually don't want to be trading those areas. So that's where noise comes in, because if your models, if you can identify the level of randomness or noise in the market, you can avoid that. And that's what I do with my models. My models are deliberately avoiding this randomness or things that don't materially contribute. And I'm looking at only things that materially contribute, which are the outliers, the nonlinear moves in the market data. That's what I'm targeting. So that's how I do it with my testing. I'm particularly ensuring that I'm not sort of doing any sort of volatility adjustment or anything like that, because that's effectively getting into the world of randomness to me. It's not materially affecting my wealth story at the end of the story, and I'm after that material wealth from simply participating in outliers.
Yeah, those are good points, Richard. I think the relation between noise, when I was speaking about earlier as well, and randomness is a very good one. I guess in a nutshell, if you're trading breakouts, what you are essentially saying, let's say a 100-day breakout, you're saying that anything other than a 100-day breakout is randomness. It's noise to my system. I'm going to ignore it until the market does make that 100-day breakout, at which point I'm going to go long or go short in terms of if it goes lower, whatever the case may be. That is essentially what the noise factor is. And I guess with the volatility stops, not to beat a dead horse here, but you're trying to eliminate some of that and say that the average market noise or randomness, what we expect to see is 1 or 2 average true range movements in the market. And if it deviates away from that, or if there is a pickup of that, if it's 4, 5, 6 times multiple of that average true range move, then that isn't anymore random. It's beyond noise. There's a bit of something happening there fundamentally. I know Jerry doesn't like that term, but just going to use it. But fundamentally, something has changed, and the market is no longer random. It's no longer making or having so much noise, and it's time to exit that move. So those were excellent points, Richard, in terms of just the noise and the random factor.
Exactly, Boris.
So here's for another another bit of controversy, Richard. And my question is, what makes that 100-day breakout or n-day breakout so special? Why do you say the border between randomness and outliers, or autocorrelation, as you more aptly call it, lies? Why is it 100 days? Why is it 25 days? Why is it 50 days? Is it because a backtest told you so? And in that way, in that sense, in what way is this method different than using a sort of moving average based signal? Isn't it effectively the same thing? You're trying to figure out a point by which you're going to go long and short. And then again, why just staking it all on that discrete event happening? And therefore, obviously, I'm now giving away all my. I already gave it, but giving away all my support and interest for a more continuous approach. And Jerry, I think your point is really good. I mean, achieving continuous trading through a multiple string of discrete system is probably the optimal, but then again, cost of capital is probably prohibitive to do that, and even the practicality of it might not be ideal. So back to my point, why? And again, I don't want to put it in a very controversial way. It's just I really struggle to reconcile why being more continuous is bad, since you really have to pick a certain event, a certain boundary condition, which separates noise from signal, as opposed to just having something a bit more gradual, that because we really don't know, we just follow. And if sure, we're going to have some noise in our trading, because trading is noisy. At least I can't make good predictions, so it's going to be noisy in my P&L. But in being a bit more continuous and a bit more sort of gentle in maneuvering my positions, I might actually achieve a better outcome, at least in terms of risk versus actually return versus pain in achieving those returns.
Bruno, the only issue I've got with continuous models, and it's the same issue I have with pyramiding. I sort of adopt this approach that these things called outliers have various forms, lots of different types of forms. So when you're applying a continuous signal, or when you're applying pyramiding, you're effectively increasing your betting exposure with the increasing signal. You're increasing your betting exposure for a single possible trajectory, because the system that you're applying that continuous signal on, if it's a single system and you're building your position size, you're concentrating your bet as that signal gets wider. So I believe that contravenes this principle of diversification of models, where what I would do is I use Donchian breakouts as one form of classic breakout model, but that's for a particular reason I use that. I use that so I avoid these type 2 errors. But then I'll also have a vast array of different trend following models, congestion breakout models, moving average crossovers, those sort of things. But each of them, they're not focusing on a single trajectory. They're focusing on different trajectories, different possible trajectories, so that when I start getting into the outlier region, when price gets exotic, it might get sort of 3 ATRs away from the normal market, then one of these systems, typically a breakout system, will click in, then a moving average crossover a bit later, then a congestion breakout will come a bit later. And so this sort of, it is almost like a continuous signal, and that different trend following models are being activated, but each of those models themselves are specifically configured to capture different aspects of that outlier. So when the outlier is over, I might have applied 10 systems on that outlier, and at the end of the day, there might only be 4 surviving at the end of that outlier, but the others would have taken segments of that outlier, but at the end, some of the longer trend following models will have captured the majority of that outlier. So at the end of the day, after the complete outlier is extinguished, I haven't found that by investing in a single path through pyramiding or a continuous signaling method with a single system. I don't find that when that single system gets knocked out, all of my positions vaporize. I find that one or two systems might be knocked out, but a large proportion of them survive for the entire period of the outlier. So that's the only issue I've got with continuous signals or pyramiding. If I might be wrong, but I'm assuming that the continuous signal is applied to a single system, and that single system has its constraint boundaries, its initial stop, its trailing stop, or whatever. That defines a particular path for the future that the trend must exist within. And I'm saying, well, the outlier could take a lot of different forms. Why not attack it with a lot of different models, trend following models?
You are not wrong in talking about pyramiding, because yes, a continuous system mimics effectively a pyramiding. So you're maximally long at the maximum signal, which obviously exposes you to the highest loss when the signal fades. However, first of all, I never spoke about using one single rule applied across all positions. Obviously, there's multiple signals, so you have as you said, you have a matrix of signals and intensity. But yes, I mean, you're not wrong in saying that instead of picking a position and effectively catching a trend at the bottom, riding all the way up and then getting out of it, because that's effectively what a Donchian system was designed to do. Obviously, with some givebacks in the middle, but largely do that. A continuous system will never be able to mimic that performance and improve on that. That's probably the best. And as Jerry says, I will always make more money than any of you guys because I follow this system. And I'm into that, absolutely. But the point is, once you develop a portfolio or a business out of it, I think there's other considerations, and one is your psychology and how you react to losses and give backs, setbacks, and things like that. So there's other considerations. I mean, no one. If this was a debate, if we were in debate class, I mean, Jerry would outscore us, all of us, and he will win the day. But the point is, real life, I think, is slightly different, and there's benefits in using a less drastic approach, at least in how I think about it. There's benefits in doing that because everything seems to be more gradual. I mean, just to give you an example, there are very, very few trades where I went from being maximally long to sort of being to lose all my profits because of an adverse market moves. What happens more often than not, you're maximally long, the market starts selling off. Your signal immediately reacts to it. And then there are other risk management overlays. Obviously, you don't want to get exposed to pyramiding. You're absolutely right. So there could be ways to address that. And so other defensive mechanisms happen, and you are, of course, losing money, but not as much as you would think, because you're sort of becoming more aggressive in protecting your profits when you need it the most. So yeah, I mean, you're absolutely right, Richard. Doing a continuous system is pyramiding. Pyramiding is bad. However, I think it's a little bit of a price that you have to pay for benefits along the lines of having a more sort of following the market a little bit more along the trajectory, because I find that the most money, certainly in my trading, I've made is not by catching a trend at the bottom and exiting at the top. It's just the meat in the middle, and this system is quite good at capturing as much as possible.
Thanks, Bruno.
Yes, very good. So I made some notes along the way, and I don't know if they're relevant now, but I think the way I look at it is that the entry and the exit signals are sort of tied together, and they don't exist apart from each other. And they're not telling me anything. There's nothing that I can find out about the market that I need to know apart from it. Do I have a buy or a sell today in this particular market? And I will in my system 1 that uses the 100-day breakout, it's short. In system 2 and it tests out very well, and it makes as much money as system 2. But system 2 uses the 125-day breakout. It's still long. So I look like a basket case. Which is it? Is the market telling you? No, it's not telling me anything. It's saying to me, buy this when you're supposed to, follow these rules, and you'll make money. And if you look at the data close enough, the reason that you're making this money is because of these outliers. So these rules that we have, they force us to be consistent over time. And then the idea is that if we maintain this consistency, having no idea what to do on any particular trade and what to do at this point in time, but if we do these trades and follow these rules and do the trades that the rules dictate for us to do, then we'll make our fair share of money over the next 50 years or the rest of our life. And then I wanted to pick on something that Bruno said about protecting profits when you need them the most. Like I would never utter those words that I need to do something when I need it the most. No, my whole mentality is I'm going to follow these rules because they're my best shot at making the most amount of money. And my whole goal is to maximize the profit in this particular trade. I have this opportunity. I'm totally fine. It's a huge success if I can make the most amount of money, but maybe also have the biggest drawdown on this trade. Who's strong enough and disciplined enough to stay in these trades when the amount of profit you're giving back is huge and it's impacting your performance. I mean, the Moderna position could dock my monthly performance for a long time. One trade. I'm supposed to be diversified. Well, you're not very diversified. That's right. Head down, following the rules, maximizing the trade on Moderna, which may make my monthly return look really bad until I actually get out of this trade. Oh, anyone in the audience, please raise your hand if you want to come on stage and comment.
Hey guys, Avi again. So following up to Bruno's comment, Jerry, you've managed external capital. I mean, I guess what I wonder about is when you have these massive drawdowns. I mean, do you see redemptions? And so you're having to close out positions when you're facing these drawdowns, knowing that in the long run the strategy is going to pan out. But if you're facing redemption, the capital's redeemed, then you're out of the game. So how have you dealt with that?
That's a really good point, and it makes me think. I've mentioned this many times and had chats with friends and colleagues. Like, is proper trading, robust trading that one can do with trend following and trading all these different markets, the safest, most diversified strategy, the perfect portfolio? Can this be a real business? Can you keep assets and make management fees by not cheating and implementing these ideas? And I think it's difficult. It has been difficult. I've told this story before that I think one year I was trading and I had some big clients and I went to visit them and maybe we were losing money for the year, but I think it was January, February, or March, and so no pressure. And I'm sure we made money that year, but when I visited them, they wanted to talk about the trading and being down on the year. And they said my biggest problem was the sugar trade. And I was like, wait a second, that is a really profitable trade. I'm kicking ass in sugar. I'm making more money in sugar than any other market. Oh yeah, it's down since January the 1st. See, that was their vantage point. Look, don't talk to us about how much you've made in sugar or you're going to make in sugar and you're going to maximize the opportunity you had in sugar. The open trade profit in sugar is lower than it was December 31st of last year, and this is concerning. And you can't talk to these people. How do you talk to them? We can't come to an agreement. None of us are clients of the other, and we have disagreements, and we adopt what these clients are saying. And they're coming out of the Turtle program. It was ingrained in our philosophy that clients are a problem. They're going to be a problem because they're, number one, they don't know how to trade. Number two is, even if they did, they would choose not to trade this particular way, and that bore itself out. And I understand why, at the end of the day, trading for a lot of people and for me is a business, and that's assets under management, that's management fees, and that's keeping clients happy. So you can give them as much classic trend following as you think they can handle, but maybe not too much. I win the argument, I win the debate, but I lose the most important thing, which is assets under management.
I think
Jerry,
that I have told before. Okay.
sorry, I thought you were going to say get a good investor relations department or team to address the queries, but that'll do as well.
I think that I have told before that a client's opinion can be even a big problem, because it's like, imagine the situation that a client, a passenger of a plane, comes to a pilot's cabin and say, what is going on here? Why I'm not at the port of destination after 20 minutes of flight, or something like that. Or why are flying in such manner? I don't want you to fly. I think it's very not safe. You are not safe. I want to be a pilot myself, or something like this. It looks very funny, but in fact, clients do the same. They want consistent. I have wrote this. They want consistent results every month, but they're almost maybe inconsistent guys in the world. And I have told that they put money when it's going into a trend, when it goes to profit, and take money away when it's a drawdown. Yes, it's. But in fact, I think we must do nothing. Only educate, try to understand. Not try, but to tell people how it works. If they don't understand this, they will give you money when you are in profit, and it will occur sooner or later, and will take away money when you are in a drawdown. And if they understand, they will be your good partners, good clients, investors. I think only that way. That clients have not such a level of experience and knowledge like experienced traders have. And of course, they think like young trader. They think they ask, why did you not close the trade? It was a very good opportunity to close the trade in profit. Why you did not do so? Why you so bad trader? Something like that. And also they like, maybe not all, of course, but they like to talk with each other about their manager. They talked about me with each other on forum a few years ago. I saw this, and we must not mention all this noise. It's also noise, like noise on the market. The opinion, it's not an expert opinion, and only long track record is the best, I think. But evidence for clients, but not for all. Not for all clients. I had a client, one person, he said that he can't handle trend following. He said that I told him how trend following works. He liked this, but he said that he can't handle this, and for him, the best way of investing is investing in passive fund. And maybe very funny looks that he told me that he was invested in passive stocks, and when he saw Corona crisis 2020, he had big losses. But he thinks that it's a better way to him to invest in passive stocks, because he is not nervous so much, and he wants to do the same. So there is a lot of psychological aspects in
I think it's not just about investors' sophistication or education. Sure, it's important to explain to them what we do and what's going on and how do we see the markets. But I'd say I disagree with you, Oleg, on this point that experienced traders would understand better what trend following is or see the value in our strategies and our way to see the world. I think it comes down to an affinity of point of view, actually. I don't know. I don't know if it's just education would be enough to convince investors to keep with us.
Jerry, correct me if I'm wrong on this, but I mean, we also have to be clear on what type of investors we're talking about. If you're talking about, your standard individual, QP or qualified purchaser or accredited investors, yeah, I don't know. You might be able to quote unquote educate them or teach them and so forth, but you're obviously going to be dealing with, people with raw emotions and different parts of their lives. And, they might be looking to redeem when you least want them to redeem. But then there are other type of investor as well as your entities, your large institutions, your pension funds. I don't know how comfortable they'd be with a back test or anything that shows, and once again, Jerry, correct me if I'm wrong, I don't know how comfortable they'd be with a back test that shows a 30% drawdown, to a large pension fund or an entity that's looking to, for a very specific strategy for a very specific time. So I think we have to clarify what or who we mean when we talk about investors. Is it Bob from across the street, or is it a large pension fund?
I agree. I mean, I agree with Bruno as well. Um, it it's almost the opposite. The more educated, the more used to looking at the markets in a traditional way, the sharp way, you'll never convince them. I got somebody so angry one time on a phone call. He wanted to invest in our fund until I said we trade single stocks and we trade them the same way as we trade the futures. And of course, me being able to slap breakouts onto a chart and trade Microsoft, just was very offensive to him. Maybe your goofy futures, but not the stocks. I went to business school. I learned how stocks are. I learned how the markets work, and you can't trend follow equities. So yeah, that's so true. It's not about education and it's more about in this 30% drawdown. Once again, our goal, and I'm not saying you can never have a bad 30% drawdown, but you can definitely have some great 30% drawdowns. Yes, I'm down 30%, I'm up 60% for the year. Now, that is where we're headed. I've used this example before on the podcast, I think, and that is, if you give me your $1 million and I start putting on the positions for your account, my trend following positions, and you're down 900,000 and I've lost 100,000, I don't like that. That's no good. That's no good. Big difference between if you're up $1.5 million now, so you've got a $500,000 profit, but it was 2 million. So now we have a major drawdown, but that's fine. And I think that when you put it in those terms, it may be too much for the highly educated, well-versed money managers to accept. But a normal guy, yeah, normal woman, yeah, they're going to totally understand. I'd rather have the 1.5 million now. Too bad I liked it when we were up to 2 million, but I prefer that scenario than you saying to me, hey, we're down 100 grand and now your account's only 900,000. And I think that's where we're coming from. Some of these ideas, they transcend spreadsheets and Excel.
Wait until you tell them that we are cavemen trend followers, outlier hunter gatherers.
Pretty good. Yes. And I think that when you're I often would go to some of these meetings at these institutions in New York City, endowments, pensions, fund of funds, and I would be able to sort of gauge the room. And because I can, this passion that I have, I can't turn it off. And so maybe you've noticed that it can reach a level 10 and it can be at a level 5. Okay, it's not always at a level 10, but I would have this same passion, because I had the answers. But let's just don't pay attention to the drawdown, open trade profit drawdown. We want to be, if we're having a big one, then we want to have made a lot of money in the past 12 months or so. But I would often gauge the room as I'm giving my presentation, and I would feel like, I think each one of these people in the room would give me their own personal money. That they'd put money in my fund in a heartbeat. But being able to get through these multiple committees and multiple screening processes that they do, no, probably not. And then you have the large European CTAs coming in, 15, 20 years ago with their pedigrees and PhDs saying, we'll give you whatever you want. We'll give you the trends, but we'll vol target, we'll keep the volatility low. And there's no cost in this. There's no downside. It's magic. And that's just like bullshit. It's a lot of cost. It's not magic. The more vol targeting one does, the larger you have to trade in order to make the same amount of money. So instead of risking 30 basis points and pushing that risk into the open trade profit, the vol targeters move the risk out of the open trade profits into now having to risk 40, 50 basis points. They're taking smaller profits. They're cutting their profits short. And my drawdowns, when I most can afford it, after very profitable periods, they look horrible. Why is Jerry so risky? But this silent killer of using a systematic approach that has 60% losing trades, these average losses are paramount as far as risk of ruin and risk control. But they're sort of silent, You can barely see them until they start adding up.
So, Jerry, how do you feel your marketing is different than, let's say, your traditional hedge fund? I mean, I guess they have a little more tailored strategies, if that's even a word. But let's say if you and, in the room, if a hedge fund guy was to come and kind of advertise these type of strategies, what are the fundamental difference in that?
Well, I don't know too much about hedge fund strategies. I do think that they're probably more likely to be concerned about not being systematic and massaging performance on a monthly basis and not allowing things to happen that are uncomfortable. I allow anything to happen until my breakout exit gets hit. And so I think, and I've heard and read over the years that maybe there's more a convergent style than divergent. Less diversification, of course, and more concentration in the equity sector. That's worked out really well. Yeah, I'm not really sure.
Interesting that I'm wondering, Jerry, if you've ever tried the Mike Covell approach to the investors, where you drop a few F-bombs.
I was on, I do this TV show, once every couple of months. It's like 10 minutes long. It's on the TD Ameritrade network. So I guess it's a TV that they do for their brokers or something. And so I get on there, and the guy's really great. He's a great interviewer, and he asks me questions usually about the markets. And it just taken me a few years to condition him to that. Okay, if you're going to ask me these fundamental questions, I'm going to twist it into a trend following answer. And but it's really fun, and I like doing it. I can't resist doing it, And but there was this one episode where I said something. I dropped an F-bomb or something, and I was like really nervous that because they usually would say at the end of the my segment, they'd say, "Thank you for being on. Great job. Blah blah blah." And then, but this time they didn't say that. So I told my wife, "Oh God, I think I'm off the TV show for saying something impolite."
Hi guys, how are you? The other day I noticed a chart about the structure of U.S. corporate equity ownership, and in the 80s it was like 60% owned by the households themselves, and now it's just 30 or something like that. So I think that there is a trend on having more and more investment committees doing the final decisions, which I guess it will be maybe bad for the business of trend following, but good for the people who will still be doing trend following, if that makes sense.
Yeah, I'll try to think of another topic, but that trend following is so accessible and so wonderful for people. And I do think that it's very difficult for people to absorb and embrace the entire methodology. We're just too influenced by other things, one being stocks and the comfort we even get if we lose money in stocks and the different rules that investors and we have in our heads of what's acceptable for stocks. And, I've never heard anyone talk bad about passive long S&P from a Sharpe ratio point of view. I mean, I know the Sharpe ratio is probably really good now, but it wasn't always good. And so, but things that are not Sharpe related, that are not stock related, like CTAs, they much higher standard for inclusion. But I, oh yeah, when I was on the podcast last week, I, I think some of these arguments that I have, I think that they're really good arguments, but then it just doesn't resonate. But I copied something that Richard had said or made me think about as relates to the S&P and the back test and how wonderful the S&P is, and even how wonderful it is if you add the S&P to CTAs, then it becomes the perfect portfolio. But my response back to Niels was, I refuse to accept any investment that doesn't have a trailing stop. It needs to cut the losses short. It needs to have a trailing stop. And it's just like, yeah, okay, then who's going to argue with that? It's not safe. I don't like it. I don't want to. What's going to happen in the future? What happens to us in the future is we have a few more losses in a row. We have some choppiness. We have a lack of trends. We're churning. We're chopping. Our performance is just chopping around. It's not going anywhere for long periods of time. And then bingo, the massive moves we've never seen before, crazy market behavior, long and short, new markets, crypto, we'll have a tendency to be perfectly situated for those things. But you walk around with a portfolio of anything that you don't have a strategy to cut your losses short and to get out when the trends, your rules dictate, your trend-based rules dictate. That's no good. That's too risky for me. And you're setting up the future for possibly things you've never seen that could be very harmful. All right. So what we'll do, we can call it a day and move on to the weekend. And unless there's anybody who wants to have some parting thoughts or comments, raise your hand or start talking. Countdown has begun.
I just want to say thanks. This is an awesome. I love this every week, this meeting. Thanks a lot, Jerry, for setting it up.
I love it too, and I learned so much, and I appreciate the camaraderie and the encouragement and the group, everybody in the group. It keeps getting a bit better. Oh, we missed Derek, though. I think he may have said that he was going to be away today, but it wouldn't be the same without the group we have, and we keep adding a few. Every now and then we get more great participants and contributors. And so I really enjoy it, look forward to it. Thank you all for being here, and
Awesome. Thanks, guys.
see you next week.
Thanks,
Have a good
guys.
weekend.
Thanks, everybody.
Bye.
Thanks,
Bye.
guys.
Thanks,
Bye-bye.
guys. Take care.